Most traders clutter their charts so badly you can hardly see the price anymore. Lines, oscillators, colored signals, like a Christmas tree that forgot what season it's in. But trading isn't about decoration. It's about understanding what the market is saying. Today, we're talking about something far simpler and far more powerful than indicators. The one setup that works better than all of them combined. And if you remember the previous video on the 4 horsemen of trading, you'll know why cutting through noise is the only path a real operator ever takes. Let me tell you, this price action is the purest voice of the market. It tells the truth long before the indicators wake up to it. Most people rely on signals that lag, on systems that comfort their doubts instead of sharpening their judgment. But the market doesn't reward comfort. It rewards clarity. You can't read the tape if your eyes are glued to 10 different indicators fighting each other. Tell me, have you ever felt that paralysis when 2 signals say buy and one says sell? You sit there waiting for confirmation, and by the time it comes, the move's already halfway done. That's not trading. That's hoping. There's one setup that doesn't lie. It's the break of a key level after a clear line of least resistance has formed. It's not fancy. It's not hidden behind code. It's a moment when the market tips its hand, and if you've been watching, you'll see it. The public never does. They look for certainty. The operator looks for opportunity. You see a range tightening, volume drying up, volatility fading, and then, bang, the tape quickens, volume expands, and the price punches through that line. That's your setup. It's the same pattern that's been playing out since ticker tape was invented. You don't need to predict, you need to observe. The crowd guesses, the trader waits. I made and lost fortunes on that difference alone, waiting for the market to show its hand, not forcing it to reveal what I want to see. The operator doesn't say, I think the price will rise. He says, when the price proves it's rising, I'll act. Big difference. Do you see it? Indicators feed on old data. They tell you what has happened, not what's happening. By the time your RSI or MACD flashes green, the professionals are already in the trade, and you're left chasing their dust. When you strip away the gadgets and watch the raw action, you'll notice the rhythm, the breath of the market. Every stock, every commodity has its own personality. Some are quick to turn, others grind like old machines. Learn their behavior, and you'll see the pattern appear in real time. That's when trading becomes an art. And art, my friend, is built on patience. The amateur wants a signal every hour. The professional might wait days for the right setup. The difference between them is hunger for action versus hunger for precision. Do you know which one you are? Now, I'm not saying indicators are useless. They're like maps. They can show you where others have been. But you can't drive looking in the rearview mirror. The market is forward motion. You must feel it, that one setup. The breakout from accumulation or the breakdown from distribution. That's the pulse of the entire operation. It's the market's way of saying, I've chosen direction. And when you listen closely enough, you'll hear it before the crowd does. Think about this, every big move begins quietly. The price goes flat, traders get bored, volume fades, and the impatient ones wander off. Then, without warning, the line gives way, and the market explodes into motion. That's the moment you've been waiting for. You don't chase it, you recognize it. That's what separates a tape reader from a gambler. Remember how, in the 4 horsemen of trading, we talked about discipline, patience, risk control, and conviction. This setup ties them all together. You can't execute a clean breakout without discipline to wait, patience to watch, risk control to size properly, and conviction to act decisively when the moment comes. That's why most traders fail. They have one horse but not the others. The market respects no half measures. The mental game is half the battle. The other half is execution. Most traders get emotional because they don't trust their setup. They rely on indicators to comfort their fear, to validate their decision. But fear has no place in trading. Confidence doesn't come from hope. It comes from preparation. When you've studied the tape long enough, when you've watched how price behaves before a real move, you no longer guess. You know what quiet accumulation looks like. You know what exhaustion looks like. And when that moment hits, you act with certainty. Not arrogance, but certainty born from observation. Ask yourself, how many times have you seen a stock break a key level, watched it fly, and then told yourself, I knew it was going to move? You knew it, but you didn't act. That's the difference between watching the market and trading it. The tape doesn't pay for opinions, it pays for executions. A setup that beats indicators isn't a secret pattern. It's understanding the behavior behind the pattern. Every setup that works over time is built on human nature. Fear and greed never change, no matter how fancy the charts become. You'll see traders pile in late, panic out early, and repeat until their account fades away. Meanwhile, the patient trader who reads the tape, who waits for that one real setup, builds steadily, quietly. You don't need to trade every day. You only need to trade when the odds are so clear that hesitation would be foolish. Think of trading as waiting for the market to hand you money, and it does, if you're patient enough to wait for that one setup. The crowd thinks success comes from action. Professionals know it comes from restraint. Every click of the mouse carries a cost, and the market collects those costs from the impatient. When I was young, I used to chase every move. I thought activity meant progress. It took me years to learn that the biggest profits come from sitting. Not sitting idle, but sitting ready. Like a hunter who knows the trail, who studied the prints, who can sense when the animal is near. You don't throw the spear too early. You wait for the right shot. That's the breakout setup. If you master that, watching, waiting, acting only when the line of least resistance gives way, you'll need no indicators, no signals, no tips. The market itself will tell you when to act. The trick is learning to listen. And once you learn to listen, really listen, you'll realize that all those tools you thought you needed were only training wheels. The market doesn't whisper through indicators, it speaks through price. True edge comes from reading behavior, not signals. Most traders don't realize this until they've spent years chasing systems that promise clarity, but only deliver confusion. The market isn't a machine that follows formulas, it's a living crowd of human emotions. Every price tick, every candle, every breakout or collapse is nothing more than behavior expressed through numbers. When you learn to read that behavior, you'll start seeing the story unfold long before the indicators even blink. Think about it for a moment. Every trader looking at the same chart sees the same price. But what separates the professional from the crowd is interpretation. The crowd reacts, the professional anticipates. A novice sees a rising line and feels excitement. A professional sees that same rise and asks, who's buying here? Is it strong hands or weak hands? Is this move being supported by conviction or by desperation? The difference lies in how they read behavior. Market behavior is simply psychology made visible. It's the sum of greed, fear, impatience, hope, and regret being acted out in real time. That's why no algorithm can fully capture it. Because the market is a mirror of human nature, and human nature doesn't change. The same mistakes traders made 100 years ago are being made today on digital screens. You can't code discipline, and you can't quantify panic. You can only learn to recognize it. When you read behavior, you begin to notice patterns that indicators can't measure. You see how volume contracts before a real move, how price hesitates at certain levels, how the tape feels different when professionals are active. You start recognizing exhaustion not by a formula, but by the rhythm of the market slowing down. You sense accumulation not by numbers alone, but by the persistence of buying pressure when the crowd has already lost interest. That's what it means to have an edge, the ability to feel what the crowd is about to realize too late. Most traders lean on indicators because they don't trust themselves. They want confirmation, a mechanical signal to silence doubt. But the best operators in history, Livermore, Wyckoff, Davos, they all relied on behavior, not gadgets. They studied how price moved, how it paused, how it tested previous highs or lows. They knew that every setup was simply a reflection of crowd psychology reaching a breaking point. Once you see it that way, the game changes. Let's take an example. Suppose a stock has been moving sideways for weeks, volume slowly drying up. The crowd gets bored, steps away. And then suddenly, one day, the price nudges higher on expanding volume. What's happening? It's not just numbers, it's behavior. The weak holders have been shaken out, strong hands are quietly stepping in, and the line of least resistance is shifting upward. That's not a signal on an indicator, that's a tell. The market is whispering that something is about to change. When you train yourself to read those tells, you'll begin to act before the crowd. That's where the edge lies, not in prediction, but in recognition. You're not guessing, you're observing. And observation, over time, builds intuition. This intuition isn't mystical, it's just pattern recognition strengthened through experience. The market rewards those who can interpret the motives behind the moves. Ask yourself, when you see a sudden spike in price, what do you think it means? Most traders jump in, thinking momentum will carry them. But a student of behavior asks, is this genuine demand or just a short, covering burst? Is the move being supported by broad buying or by panic from the other side? The difference in those questions can mean the difference between profit and loss. You see, signals simplify, but they also blind. They make you look for certainty in a place where certainty doesn't exist. The professional doesn't need certainty, he needs probability. Reading behavior gives you that probability because it tells you what the crowd is feeling, and crowds act in predictable ways under pressure. When the masses are euphoric, the end is near. When they're despondent, the bottom is close. These aren't signals, they're emotions translated into price. Reading behavior also keeps you aligned with the market's tempo. Every market has its own rhythm, and that rhythm changes with sentiment. Sometimes it's fast, sharp, impulsive. Other times it's sluggish and deceptive. Indicators can't tell you that. Only observation can. You learn to feel the pace, to sense when a move has energy or when it's running out of steam. That's the kind of sensitivity that builds confidence. Because you're no longer reacting to tools, you're responding to the market itself. The great irony is that traders keep searching for a perfect system when the real edge has been in front of them all along, the human element. Watch how people behave around money, around profit and loss, and you'll understand every chart ever printed. Price patterns repeat, not because the market is mechanical, but because human behavior repeats. The fear of missing out, the urge to cut winners too soon, the denial during drawdowns, it all plays out on the tape. Once you accept that, trading becomes less about prediction and more about patience. You wait for behavior to confirm your thesis. You wait for the market to show you that emotion has tipped too far one way. You act when the imbalance is visible, not when your indicator blinks, but when the crowd's emotion becomes extreme. That's the moment professionals step in quietly, while the public shouts in excitement or despair. So reading behavior isn't just about charts, it's about mindset. You have to train yourself to stay calm when others panic, to stay skeptical when others are euphoric. You must learn to think like the minority, because the minority is where the profit lies. Most traders react to what they see. The few act on what they understand. That's what true edge is. It's not about finding a secret formula or a magic signal. It's about developing the eyes to see what others overlook, the patience to wait for confirmation in behavior, and the courage to act when that behavior aligns with your preparation. Price action reveals truth before indicators react. That single sentence separates the trader from the gambler, the observer from the believer. The market speaks through price. Pure, unfiltered, immediate. Indicators only echo that voice after it's already spoken. The professional trader listens directly to the source, while the amateur waits for translation. But by the time that translation arrives, the meaning has already changed. Price action is the heartbeat of the market. Every tick, every bar, every candle tells a story. It's the record of what buyers and sellers have actually done, not what they might do. The closing price of every bar is the result of all opinions, all hopes, all fears, and all capital in that moment. You don't need to decode it through 10 different tools. You need to see it raw and unfiltered. When price moves, it's telling you where strength is entering and where weakness is hiding. That's truth. The rest is commentary. Indicators, no matter how complex, are built from past data. They calculate averages, differences, and ratios useful, sometimes, but timely? Never. They trail behind price like footprints in the sand. They show you where the market was, not where it's going. When the crowd waits for confirmation from an indicator, the professionals have already moved on. Ask yourself, how many times have you seen a breakout happen, then waited for your signal to turn positive, only to see the move halfway done? That's the lag of false certainty. Reading price action is like reading a book written in motion. Each bar builds upon the previous, each reaction reveals intent. You start to notice subtle things. How the market behaves after a strong move, how volume accompanies expansion or dries up during rest, how certain levels attract reaction again and again. You begin to sense character. Every market has one. Some move impulsively, others hesitate and test. When you know their character, you stop reacting, you anticipate. Price tells you what's real because it can't hide. The crowd can believe anything it wants, but price will always reveal the truth. When a stock refuses to fall despite bad news, that's strength. When it fails to rise despite good news, that's weakness. The tape is the judge, jury, and executioner. Indicators can justify your bias, but price will always strip it bare. Most traders don't trust price because it feels uncertain. They crave validation from tools that give them a sense of control. But trading isn't about control, it's about alignment. You don't control the market, you align with it. And alignment comes only from observation. Watch price long enough and you'll start noticing repetition. The same types of movements that precede breakouts, the same pauses before reversals. That recognition is your real signal. It's living, breathing data, not a delayed calculation. When you learn to trust price, you begin to trade differently. You stop needing confirmation. You stop overanalyzing. You learn to act when you see something, not when a tool tells you it's safe. The irony is that the safest trades are usually the ones that feel uncomfortable. That's because they occur before the crowd catches on. The crowd waits for confirmation. The professional acts on observation. Which one do you want to be? The market rewards those who can see strength or weakness before it becomes obvious. That's what price action gives you. For instance, when a market rallies into resistance and then pauses with small candles, the amateur sees indecision. The experienced trader sees absorption. The smart money quietly taking in supply. When the breakout follows, the novice calls it a surprise. The professional calls it confirmation of what price already told him days ago. Indicators can't capture that. They can't see intention. They can't feel pressure building. They can't distinguish between quiet accumulation and noisy volatility. Price can. The chart tells you everything you need if you know how to listen. The key is to shift your focus from signals to structure. Instead of asking, what does the RSI say? Ask, who's in control here? The buyers or the sellers? Instead of measuring moving averages, measure the story unfolding between supply and demand. Price action also keeps your emotions in check because it forces you to deal with what's happening now, not what you hope will happen. An indicator can comfort you by saying, stay in, the trend is fine. But the chart might be screaming, distribution. Price doesn't sugarcoat. It exposes truth without apology. And truth, though uncomfortable, is what protects capital. In every major move, price whispers early. The breakout that everyone sees on the daily chart began as subtle accumulation on the lower time frames. The trend reversal that the indicators catch late was already visible through failed breakouts and waning momentum. Price warned, but few listened. Most traders only react when the evidence becomes overwhelming, and by then, the easy money is gone. This is why traders like Jesse Livermore spent their lives studying the tape. He called it reading the market's mind. He didn't wait for signals, he watched behavior. When price showed persistence, he knew buyers were serious. When reactions came shallow, he knew strength was building. He acted when price proved the path of least resistance, not when an indicator confirmed it afterward. Price action reading isn't about prediction, it's about recognition. You recognize when something has changed, when energy shifts, when balance tips. You don't need to know why. The market doesn't pay for explanations, only for timing. When you can see those shifts in real time, you're already ahead of most participants. Do you know what gives traders the illusion of safety? Complexity. They believe the more indicators they use, the more control they have. But control is an illusion. Clarity comes from simplicity. Strip away the clutter and you'll see that price alone carries all the information you need. Trend, strength, momentum, exhaustion, interest. The rest just delays your decisions. The truth is, the market doesn't reward those who analyze the most data. It rewards those who understand the data they have. Price is the purest data point available. It's the result of every decision made by every participant across the globe. It's the pulse of fear and greed, visible second by second. When you read price directly, you read human nature in its most honest form. Once you learn to trust that, you'll never again depend on lagging confirmation. You'll trade from observation, not interpretation. You'll see what others miss because you're not waiting for permission to act. Indicators lag, price leads. That's one of those truths that every trader hears early on, but few ever truly grasp. It sounds simple, even obvious, but understanding it deeply can change how you trade forever. Every indicator, no matter how sophisticated or beautifully coded, is built on past price data. It's a mathematical reflection of what has already happened. The problem is, by the time it tells you something, the market has already moved. Price, on the other hand, is always current. It's the real, time expression of value, pressure, emotion, and intent. The trader who learns to read price directly stays ahead. The one who depends on indicators follows behind, hoping to catch up. Think of it this way. If price is the story being told right now, indicators are the summary written after the chapter ends. They interpret what's already done. Useful for reflection, maybe, but dangerous for timing. In trading, timing is everything. If you're late by just a few moments, the best part of the move is gone. You're left chasing entries that no longer make sense, risking your capital on faded momentum. Have you ever bought a stock because your signal flashed buy, only to watch the price stall or reverse immediately after? That's what lag does. It feeds you delayed confidence. The truth is that indicators make most traders feel safer, not smarter. They give the illusion of clarity. A colored signal or a crossing line feels objective, mechanical, even scientific. But the market doesn't move because of math. It moves because of behavior. The crowd's greed and fear show up in price first. The indicator only echoes that behavior once it's already visible. Professionals don't wait for that echo. They act on the first whisper. Price leads because it's where decisions meet money. Every tick represents a transaction where someone bought and someone sold, both convinced they're right. The constant battle between those forces creates the market's rhythm. When buyers overpower sellers, price rises. When sellers gain control, price falls. It's simple in theory but subtle in practice. That's why reading the tape, watching price itself, is a skill that separates operators from analysts. Analysts explain what happened. Operators profit from what's happening. You can use indicators to support your view, but never to lead it. Because once you start relying on them as decision triggers, you've surrendered your timing to lag, and lag costs money. Imagine driving a car with a GPS that updates every minute instead of in real time. You'd always be behind the turn. That's how most traders operate. Their indicators tell them what price did, not what it's doing. When you focus on price, you begin to sense transitions. You see how markets slow before they turn, how candles narrow near exhaustion, how volume swells as conviction returns. You notice how certain levels attract action. Previous highs, round numbers, zones of consolidation. Price action shows you the battlefield in motion. Indicators only show you the footprints after the fight. This is why many traders feel trapped in a cycle of whipsaws. They wait for an indicator to confirm a move, enter late, get stopped when price corrects. Then miss the next leg because they're shaken. They blame their strategy or tweak their settings, but the real issue isn't the settings. It's the lag. They're reacting instead of reading. They're following a translation instead of listening to the original language. The market is fast and fluid. It rewards decisiveness. To act decisively, you need to read what's leading, not what's lagging. That means training your eyes to interpret raw price. A breakout that holds above resistance tells you more than any moving average crossover. A failure to make a new low after heavy selling tells you more than any oscillator. The key is learning to interpret these signs in context. Price is not random. It reflects intent, accumulation, and exhaustion. Price leads because it reflects where the smart money is positioning. Big operators don't announce their trades, they leave clues in the way price behaves. Slow, steady accumulation near support, tight ranges after pullbacks, or controlled reactions during news. These are all footprints of strength. By the time your indicator turns bullish, the professionals are already long. They bought while the crowd waited for confirmation. Ask yourself, what are you really looking for when you stare at an indicator? Certainty. You want to be told when it's safe. But the market doesn't pay you for safety. It pays you for risk managed through understanding. Price tells you the truth, even when it's uncomfortable. Indicators tell you what you want to hear. If you're willing to read the raw data, you'll always be closer to the truth. When price leads, it gives you real-time feedback. It tells you if your trade idea is working or not. There's no need to wait for an indicator to cross a line. If you buy and price fails to hold its level, you're wrong. Simple as that. The market doesn't need to print a red signal to confirm it. This simplicity is liberating. It strips trading down to its essentials: entry, risk, observation, and reaction. Learning to trust price over indicators also changes how you think about trends. A trend isn't a line. It's a sequence of behavior. Higher highs and higher lows in an uptrend show strength and control. When that sequence breaks, momentum shifts. You can see it instantly in price action, long before your indicator starts showing divergence. Those moments of transition, the small cracks before reversal, are invisible to lagging tools. They're clear only to those watching price itself. You don't need to discard indicators completely, but you must understand their place. They're supporting actors, not the lead role. Use them to confirm structure, to filter volatility, to measure extremes, but never to dictate action. Your main focus should always be price, because price is the present, and in the market, the present is all that matters. The professionals, the operators who move serious money, trade off what they see happening, not what their screen tells them might have happened. They know indicators lag because they understand human behavior lags too. The crowd is always one step late, chasing what just happened. The operator anticipates what's next by reading what's leading. That's why price will always be the purest signal, the only one that doesn't lie. The best trades begin in quiet, low volume phases. That's something most traders never learn because they're too busy chasing the noise. They want excitement, movement, confirmation, and action. But the market doesn't reward excitement. It rewards patience. The big moves, the kind that change an account, almost always start quietly. They form in silence while the crowd is bored or distracted. That's when professionals are positioning, and the tape is whispering what's coming next. Every great trend begins the same way: the public loses interest. The market drifts sideways, volume dries up, volatility fades, and most traders move on, calling it dead money. But the professionals know better. They understand that price isn't resting, it's preparing. It's gathering strength for the next directional push, like a coiled spring. The quieter it gets, the more energy builds beneath the surface. Have you ever noticed how the biggest breakouts often come after weeks of dull, lifeless trading? That's not coincidence. That's the rhythm of the market. The quiet phase is where accumulation or distribution happens. Smart money doesn't buy in the middle of a frenzy. They buy when no one's paying attention. They accumulate gradually, keeping the market calm to avoid attracting attention. That's why volume is light. The big players don't want to disturb the price. They work their orders patiently, letting the market absorb their buying. When their positions are built, then, and only then, does the real move begin. By the time volume spikes and headlines catch on, the professionals are already in. Most traders get trapped because they mistake quiet for weakness. They assume that if price isn't moving, nothing is happening. They crave volatility, so they look elsewhere. But in doing so, They miss the one thing that matters most: positioning. Trading is a game of preparation. The calm before the storm is the moment when you should be watching most closely. When the market is slow, that's your chance to study its behavior. Who's holding? Who's letting go? Where the balance of pressure is shifting. Those clues are invisible when the tape is wild. In the quiet, the market reveals its truth. You can see the subtle signs: support holding firm even after weak attempts to break it, resistance refusing to give despite light testing, volume drying up as traders lose conviction. These are the fingerprints of accumulation or distribution. A patient trader learns to love this phase because it's where the foundation for profit is built. Impulsive traders see nothing happening. Experienced traders see opportunity forming. When you look back on your best trades, you'll notice something. They didn't start when everyone was talking about them. They started when no one cared. The perfect trade often begins when the crowd has lost hope. That's when risk is smallest and potential is greatest. Because when the crowd is disinterested, prices are stable, stop placements are clear, and volatility is low.